Hello, everybody. Awesome. Everybody can hear us. Welcome to Multi-Freedom Chasers, the Multi-Freedom Chasers. Oh my gosh, I can't speak today. What's wrong with me? Sorry, guys. Hello, everyone. Welcome to the Multi-Freedom Chasers financial Zoom on Wednesday night. How is everybody doing today? I hope everybody's doing good. Jerry just took over my screen. That's okay. Go ahead. Let me know how you're doing. Thanks for joining, guys.
All right.
Doing awesome.
Yeah.
Good.
So, welcome everybody. Start here with today's agenda. We'll talk a little bit about the community ecosystems. We'll introduce ourselves and give you guys a chance to introduce yourself. We'll go into the current debt market, and then our main topic is all about agency financing for multifamily. And then we'll do some question and answer at the end. So getting started, a lot of you guys and girls are familiar faces. So you guys have seen the Multifamily Freedom Chasers community page here before. Right now we've got calls Sunday to Wednesday nights. More information on these calls than some of the paid programs. I will say that because I've seen some of them. So, this is all free educational and networking events that everybody can join. And I do believe that we have some more going to be starting up here within the next couple of weeks to a month. We'll have some other nights added. So we've got some more Freedom Chasers leaders have stepped up and going to be doing some other nights with calls. So looking forward to that and seeing what else we're going to have to add.
I see Andrea is in the call. She's one of our leaders now. Hi, Andrea.
And BB, I think, is in here too.
Oh yeah, BB. Hi.
And if I missed anybody, I'm sorry.
But I will throw that link in the chat so you guys can have it. If you guys don't already have it, I'm just going to throw it in there just in case for the Facebook page to join so you can get all this free stuff that we're doing.
Yep. So now, who are the Miles? I am Jerry Miles, and that is my wife, Shelly. JJ will be jumping on here shortly, and Jordan's back in there in the picture as well. We are commercial mortgage brokers and co-founders, each of us, of Adventure Commercial Capital. We lend on commercial and investment real estate nationwide. We started this business about 3 years ago because we saw a need for lending brokers who were going to be honest and treat people fairly. We had been not treated fairly in the past by lending brokers, and thought that we could fill this niche and take care of people and grow a business at the same time. So that's what got us started, and so here we are 3 years later, and we survived COVID, and now we're going to survive the Fed raising rates on us. So we're going to make it, and we'll be around for a long time, y'all. So I'll give you a chance. If anybody wants to introduce yourselves, I ask that you'd keep it to about a minute each. But if anybody wants to jump in and tell us who you are and where you're from and all that good stuff, jump in and do it.
I guess I'll start out. This is Edward Kempen.
There you go, Ed. Hey, before you get started, good job on the club call today.
That's right. Yeah, looking forward to some financing package from you on that potentially. See how it goes.
Yeah.
Anyway, I'm a multifamily investor here in Southeast Michigan. I'm in several other syndicated deals, but also know a lot of people that are looking to get involved in it. So I think that this might be a good supplement, passing on the referrals as well. So
awesome.
Just want to do this to add on another aspect of my well-rounded real estate background. So
awesome.
I'm involved in several syndications, I think across 4 or 5 states right now. I'm not sure exactly, and quite a few units here in Michigan. So
Awesome. Awesome. Yeah, Ed's in the Grand Cardone Real Estate Club and presented a deal in the Shark Tank, I guess you could call it today, and presented a nice deal. So we're hopefully be able to work together on it here. So anybody
I'm
else?
Lene. Yeah, Lene
ahead.
Anderson. I live in Boynton Beach, Florida. I am presently looking up in Jacksonville. I'm trying to get into a couple of fix and flips, and then I'm wanting to get into more multifamily. I already own an 8-apartment complex in Idaho. I've had a couple of the rentals in the state of Washington, but I just sold those a couple of years ago. So I'm wanting to expand over here on the East Coast.
Awesome. Glad that you're here.
Thank
And
you.
it's Lene, right?
Yes, the
Okay.
the S throws everybody.
Yeah.
Hey, Jerry, how are you this evening?
Awesome. Who's talking?
This is Sean Thompson. How are you?
Hey, Sean, how's it going?
Going good, sir.
Doing
Hadn't
well.
seen you in a little while.
Yeah.
I'm also part of the Grant Cardone. That's how I met Jerry, through the Grant Cardone Real Estate Club. I'm also part of Brad Sumrock's group and also Gabe Bowling's group. I'm from Knoxville, Tennessee, but this week I'm in Destin, Florida, looking at 120 units that we've got an offer accepted on. And I just came down to walk the property before we signed the PSA on it. And I've got to drop off here soon because we've got a flight here in a little while. But I wanted to join your group and say hello to you because I hadn't seen you in a while.
Yeah.
And tell everybody if they've got any deals anywhere in East Tennessee or Middle Tennessee, I'd be happy to help them with it. And also, I'd like to KP your deal. If you guys have a deal and you need a sponsor, I can help you KP something for you up to 12 million.
Awesome. Hey, that's big, guys. You want to put your information in the chat there, Sean?
Yes, sir, I will. Thank you. Thank you for inviting me to do that. I appreciate it.
Yeah, for sure. And you guys, that's a big deal having somebody coming on and saying that. So
Take advantage of that, guys. Come on. Let's go. That's awesome, Sean. Thank you.
I appreciate you being here, Sean.
Have a safe flight, buddy.
Thank you so much. I appreciate it.
Yeah.
You guys, that was huge right there. Go ahead and take his information. That's what we do these calls for, is to connect
Yep.
people with this.
That's it. That's it. So, what is the Fed going to do this month with the rates? And that's kind of the question on everybody's mind. If you turn on CNBC or Bloomberg or any of these different news networks or anything else, they're all going to have their own opinion. And they're going to have people that say they're going to raise them. They're going to have people on there saying they're not.
Yeah.
I think that we might be in for another raise
Đúng
here.
không? It's like you first to say.
I'm sorry, Elise. Oh, okay. I think we might end up having another rate hike here this July. Just that's kind of what the consensus looks like. There's different groups that put together percentages of what's the percentage of chance that this is going to happen or that's going to happen. And one that I was hearing today, they're saying there's a 76% chance that they're going to raise rates again in July and possibly hold come September, and then towards the end of the year they'll do another raise. They might have it planned out that way, but once we get past this month, who knows? I know that in some ways they say that the CPI report today was a good report. People were happy about it, that CPI is going down. But at the same time, you have people on the other side that are saying it's not good enough, that the job market's still too strong and all these things, so but like I said, I think this month we're gonna have the rates kick up again. I'll go through a sheet here in a minute that'll show what the rates have done in just the last 2 months when you look at the treasuries. But yeah, that's the question on everybody's mind right now. So, the current debt market, we're still the Fed rates 5 to 5.25. SOFR, or the secured overnight financing rate, 5.06. A lot of bridge debt is based upon the SOFR rate. They might be 5 points, 4 points over SOFR. The 10-year Treasury finished the day at 3.85. But it has been up over 4 here this week. So I think it was up over 4 yesterday. So, our agency debt and things is based on the 10-year Treasury. Rates are up. What's that mean? That means, for apartment buyers, and apartment owners, values are down. If you bought a property, at the height, at the peak here, last year, the year before, your property is probably not worth what you paid for it. Because we've had the rates have kicked up, and it's killed cap rates, and and just to add kind of salt to the wound, a lot of states are having troubles with insurance and taxes and everything else going up. So right now we're kind of in a stagnant market because of that. Sellers aren't going to sell until they have to. So even if they're bleeding out money right now, they're thinking, oh, if I can just get through the next 6 months, or I can just get through the next year, that we'll be able to make it and things will get better. I hope so. But there's no guarantee of that. So as of right now, the market's kind of stagnant until, sellers decide to start coming off of where they're at, or they start having to sell, that maybe they're running out of money and cash to keep their deals going. On the call today, the real estate club call, Grant went on for 10 minutes about different people that are walking away from deals, and like they can't get what they paid for it, and they're just turning the keys over to the bank and saying, hey, we can't do it no more. And he was naming off quite a few different people that are doing that. So blood in the streets for sure right now, and we'll see how it all plays out. He was saying that it might be 2025 before things start getting better. So, but nobody knows, but it's good to keep an eye and kind of see as we start seeing more and more people foreclosing. That's when we're going to start seeing more deals hit the market, I think. So here I'm going to show you kind of our current rate. Well, first I'll show you our rates 2 months ago, the small balance rates for Freddie and Fannie. This is what we could have offered 2 months ago. We're in the 5.5 range to 5.25 up to 6, kind of at the top. And you see that most of them are 5s. You look today, we're in the 6s. A lot of the way across the board, we're in 6s, and we even see a 7 or 2 in there. So rates are going up. This here actually was a few days ago. The rates are probably jumped up again since then. I think we're probably in the upper 6s mostly now when you're looking at agency debt. So, and I wouldn't look at this and get discouraged in any way. I would look at it and say, hey, this is going to force some people to give me some good deals on property. So stay in the game, keep looking at deals, and Grant, I keep hearing him say on our club calls and different things, as he's talking, he's like, man, I want to rip somebody's face off, talking about going out and getting a good deal. So so this here is what's going to allow you to be able to do that. So the next slide here, I'm going to share with you all. Some of you guys have seen this, some of you haven't. This right here is probably our best product that we have available to customers right now. This is our development line of credit. The development goes 20 million to 2 billion is what they say. They funded They funded deals as low as 5 million, and they've recently funded a deal in South Korea for 17 billion. So, there's a big range of what we can do with this product. But like I said, it's development projects. We can fund up to $100,000 or up to 100% of the project. So it's a cool product. Take a screenshot of it. If you know a developer, bring us a deal, introduce us, and we can get you paid on this. And we could get you a referral fee on these deals. So, but on to the main topic.
Okay, that's fine. Sorry.
All right, so our main topic tonight, agency financing. And when I'm talking agency financing, this is, Freddie, Fannie, HUD. Those are agencies as well, but Freddie and Fannie are the main ones when we're looking at agency debt. Why do we use them to fund multifamily? Freddie and Fannie are government organizations that are here to provide, affordable housing. So they're here. They have money to lend, to apartment buyers, and they're going to give you good rates and terms because they want you to provide affordable housing to the public. So that's the whole mission behind Freddie and Fannie. So the reason we use them, generally better rates, especially right now as we're running into the banks and things, hurting and starting to fail and things. Long amortization, 25 to 30 years, usually 30. We have options at 35 and 40 as well for certain products. Non-recourse, we can lend up to 80% loan to value on purchases and up to 75% on refis, and as low as a 1.2 DSCR. Kind of in this market, that DSCR of 1.2, I haven't been seeing. The lenders like to stick up around that 1.3 because kind of the uncertainty of the market. And like I said before, why do we use Freddie and Fannie to fund multifamily? Is because they have money. They have funds sitting there, and they didn't use them all last year, and they're on target to not use all their funds again this year right now. So they need to use their money. That's what they're here for, is to fund multifamily. And if they're not meeting their quotas and things, they're going to have questions to answer.
So what was the key driver of this? It seems like they always used to use shorter term financing. And is this part of the resolving the issues with the current debt crisis we have in commercial right now?
Are you meaning like, yeah, they still offer 3, 5, 7, 10-year terms, but the amortization is still a 30-year. It's, your loans are figured on a 30-year spread there. So you're still going to get your best rates with a 5-year term, 7-year term, sometimes even a 3-year term. So they're still, the rate will be locked in for 5 years or 7 years or 10, and then you're going to go to an adjustable after that time period. So
okay.
Yep. They do have, you can do a full 30-year term, but those rates that I showed before, you'll probably be a full point higher if you go to a full 30-year term. So not many people do that in the commercial end, especially. So
Right. not typically held that long. Okay.
Yeah. So, asset requirements, and these are, you know, when we're looking at agency debt, you know, the agency debt is very fluid, they say. There, you know, when you're looking at requirements, there's always things that can come up that can change their mind. As far as if you're looking at a really good asset and a really strong market, that 90% or better, I mean, they can come down to 85 to fund the deal if they really like the deal. You know, so just keep that in mind. You know, really good deals, really strong borrowers aren't going to have to show as much as far as liquidity and things when they close a deal. You know, just there's all kinds of different nuances and things that can be exceptions to these rules, but these are just kind of your basic rules to go by as we go through them. So just remember that 90% or better occupancy for three or more months is a requirement. Properties need to be in strong markets to get the best rates and terms. And when I say strong markets, I'm talking like high populations, you know, multiple employers in the area, you know, big employers. Properties need to be in good condition with minimal maintenance needed. Student housing, if it is student housing, it needs to be a top tier university. And minimum of 12,000 students. But I would say if it's not one of your big state schools, like here in our area, we would have like University of Louisville, University of Kentucky, University of Cincinnati's close by. Those three colleges would probably be the ones that Freddie and Fannie would be interested in funding things for. When we start looking at other colleges like Northern Kentucky University, Xavier's smaller compared to those, just, you know, they're looking at the big colleges that have you know, long historical presence and things that they want to lend on, you know. So if it's in a military town, has to be less than 40% military. And the reasoning behind that is just the asset, you know, let's say you're in, I don't know, Jackson, North Carolina is a big military town. You know, you have a bunch of military living in your apartment, and the Marines or whoever it is there, that they decide that they're going to not get rid of that part of their branch, but they're going to move that part of that base. They're going to move to Fort Sill, Oklahoma, or wherever it is. They're just going to move them and get them out of there, or something like that. And your occupancy drops, you know, 50% because all those families move out of the apartment, you know. So they're worried about those types of things with the military housing. Short-term rentals must be less than 10%. So if you have an apartment complex where you have some short-term rentals in there, has to be less than 10%. There's no, I've not seen any exceptions on that. And also something to note, mobile home parks can be funded through agency debt. So Freddie and Fannie will fund trailer parks. So that's the asset requirements. Going on to borrower requirements. Experience, number one. So that's where when Sean was talking before of, you know, he would KP deals. Experience. The lenders are looking at experience more than ever because of the way the market's going. They want an experienced person on the deal because they want to know that their deal's going to be managed right. So the next one is kind of a you know, it's criteria for just about any commercial loan out there except for SBAs. But the net worth of the GP team or the KP needs to be equal to or greater than the loan amount. So if you have 3 people on a GP team together have a $5 million net worth, you guys could borrow $5 million. Liquidity on purchases needs to be 10% after closing, and that's just a general rule. Liquidity on cash out refis, needs to be 10% pre-closing. And then something else that's important that, you might hear a lot of the gurus talk about, and they say, oh, you don't need a credit score, you don't need this and that. If you're going after an agency loan, maybe after 10 of them, they're not going to look at your credit score anymore. You get that net worth way up there. They're just going to look at that. But if you're buying a deal or you're KP on a deal, it's under 20 million, you've got, just barely 20 million in assets or whatever, they're going to look at your credit score and it needs to be a 660 or better. So as you grow your portfolio, that becomes less important, but especially at the beginning, and as you're growing and buying deals, that's important also. So now we'll disqualify people on the GP team also. So they're going to look anybody over, I think it's 10% ownership of, or a 10% management party on the GP team needs to have that credit score as well. So what can you do today to prepare? Make sure your credit's in order. I didn't put this on there, but networking. When Sean got on here before, he's looking to KP deals, networking with people like that. Networking with people that can buy deals. When you find deals, you take it to them and use them. Work on your own PFS or personal financial statement, your own SREO. If you think it's too little to worry about, and let's say you've got 1 or 2 properties, put them on a sheet of paper and start tracking your personal financial statement. Start tracking it. And if you don't track it, it's harder to manage and to, if you've ever read Rich Dad Poor Dad, they talk about the asset column and putting more things in the asset column and less in, what do they call it? I can't think of the right words.
Liability.
Yeah, liability.
Liability.
Yeah, assets and liability. Thank you, Elise. Start tracking what you have there. So, and that'll help you if you don't know what it is. Get on there and start writing things down. Do you own a small business? Whatever it is that is an asset to you, write it down in the asset column. If you owe car notes and have credit card debt and all those things, put those in the liability unless you're using the credit cards for to flip a house or something. So get your bio together. All the education you're doing, hey, I'm a part of the Multifamily Freedom Chasers, and I've gone through their educational courses, which if you're on these calls, that's our educational courses. Work on raising capital, or just work on making more money. Figure ways out to make more money. And we launched our referral program last week. I know some of you guys were on the call. Some of you guys, girls, when I say guys, that means everybody, not just guys. But we launched our referral program, and that's a way to start bringing in extra income and things. So costs money to buy deals, whether you get it from other people or you're doing it yourself. You got to have money. So all right, I'm gonna open it up for questions. So if anybody's got any questions, you can put them in the chat or just raise your hand and we'll bring you up and answer them. Man, we're doing good on time today, ain't we?
Yes, we are.
I have a question for you, Jerry.
Yeah.
So in terms of asset requirements, are there any differences between the agency and small balance? Is it still 90% occupancy, 3 months or more, or are they different for the small balance?
No, it's the same. When you have, I showed the rates for the small balance, and then they have the conventional as well. it's all the same as far as the requirements there.
Okay, so the only thing would be different is just the interest rates, but in terms of guidelines and such, it's essentially the
Yep.
same between agency and small balance. Okay.
Essentially the same, yeah. And so just to clarify for everybody, you see Fannie Mae is 2 million to 6 million. Freddie Mac is 2 million to 7.5 million. Each of them will go down to 1 million. They try not to, and they scrutinize them deals even more. But we can go all the way down to 1 million on those amounts. But once you hit that 7.5 with Freddie, or you hit the 6 million with Fannie, then you're into their conventional products, and those will go all the way up to 100 million.
So Jerry, while you have that up, I'm noticing the differences between what looks to be the loan to value and the DSCR. So
Yep.
where would the constraint be? Is it the greater or lesser of the two? So they go to 80% as long as you have at least a 1.2. Is that how I read that?
Yep.
Okay.
Yep. And what I've been seeing lately is if you get to an 80%, 1.2, you're doing really good, because I haven't seen any deals that get to that point here. And I mean, a
So
lot of times you're at 1.2 and it's a 65%, and then they're going to say, well, we need to take you down to a 60 so we get to that 1.3.
Okay. So for underwriting purposes, you're saying go no greater than 60% or so, even though if you have an attractive
Even
DSCR?
Yeah, even more than that, I would say stick around your 1.3 DSCR. So
1.3.
if you can get a
Okay.
1.3 DSCR with a 75% loan to value or 80% loan to value, I mean, that deal can be done for sure. But if it's a 1.2 at an 80%, I mean, chances are they're going to say, let's take you back to 75 or 73 or whatever it is that gets you to that 1.3,
I was going to ask you this last week, but we ran out of time. I was going to ask, when do most engage you for a debt quote? Is it after they are pretty confident they're going to submit an LOI? Is that typically when they'll involve you or Shelly?
I have some that just every deal they're looking at, they'll call me and ask me what I think about it. And I have others that, call me after they've sent an LOI in and they're waiting to hear back, or they might even have one accepted and they call me, so. And sometimes I don't know if those are people that maybe were working with somebody else and they, maybe got turned down or something along those lines as well. You just never know. So, but
It's always best to include us like at the beginning. This way, we could be part of the negotiating too as well, because we can say, hey, you can't get it for this because of the DSCR, and you can go back and do your bidding through that and just blame it on the lender. Like, I can't they can't lend on this because this is why, because of the DSCR. So, I mean, it's up to you, whatever you want to do, but we like to be included at the beginning, but it doesn't matter to us. I mean, if you come after you submit an LOI, it's fine. But like I said, we can help I don't know how to say it, but like helps, like if you have to go back and negotiate the price, we can be the ones you can blame because it helps you. You know what I'm saying? You know what I'm saying?
I
Like,
got you, Shelly.
I'm sorry.
I got you.
It helps.
Thank you, guys.
It
for
helps
sure.
a little bit.
Yeah,
And you can get your price lower, that way, negotiating wise.
sometimes if they're
Well,
needing to
yeah,
sell,
sometimes, not all the time, but sometimes, yeah.
I mean, just keep in mind, when you're looking at deals, a lot of deals right now, according to where we are in the market, are overpriced. I mean, I feel like just about everything I've looked at's been overpriced. And just, when you're looking at a deal and it's spitting out 3% cash on cash, for your investors, year one, cash on cash is 3% or 4%. Keep in mind, they're investing in real estate. It's a stable investment, all these things. But which is more stable if you're able to invest in a 10-year treasury that's 4%, or equity into a real estate deal and you're getting 3.5%. That's not a guaranteed 3.5%. I mean, if you look at that and you think about it in those terms, which is a more stable investment to invest in? I mean, that US Treasury bond at 4% is a way safer bet, than the real estate. So when you're looking at a deal, I would be looking and saying, hey, how quickly can I get this up to an 8, 9, 10% cash on cash? Because you're using other people's money on these deals a lot of times and bringing them back 3% cash on cash. I mean, that's somewhat, it's not, I mean, it's not a risky investment in one hand, but and when you compare it to what else is out there on the market right now with a treasury that's spitting out 4%, it is a risky investment in comparison, right? So, I mean, use that as a negotiating tool, say, hey, my cash on cash is going to be, less than what I get from a 10-year treasury bond, and tell that to the broker and tell them, look, you need to talk to your buyer or whatever,
That's
So,
what I was trying to say, negotiating tool.
yeah.
Didn't think of it.
Yeah. So. Yeah, any other questions? I haven't looked at the chat to see if there's any questions there. I see. Okay, if we brought you in during underwriting, would that be better? Yes, that's always better, Leonard. Yes.
Yeah, the earlier the better, but like I said, we can do whenever.
I'm here to use and abuse. Call me and use me and have me looking at deals all the time. So
He gets calls all the time. He got 4 calls today and he just spits out the deal super quick when he has time, and it helps you in your underwriting process.
and I'll be looking at deals when we get off of here. I've got people that have sent me deals. I'll be looking at their deals tonight before we go to bed. So
Hi, Elise. Were you trying to say something earlier? Do you want to jump on and say something?
I forgot what I was going to say. Maybe I was trying to introduce myself and said, yeah.
You can go ahead.
okay. Well, go
Yeah.
ahead and do that, Elise.
Elise is
Sorry
our
to
good
cut you off.
Okay. Well, my name is Elise Lynn, and I am in Indiana, actually, I call it Cincinnati area because I'm only 20 minutes from Cincinnati. I've been in a multifamily business real estate business since 2003. And we also, my husband and I, we owned and operated a 31 units in Huntsville, Alabama for 14 years. And that was a lot of learning. And now we're doing syndication and learning about just how to bring the deals together and really help people invest in real estate and not have to do anything like what we did, clean the toilet, fixing the leaks, getting rid of the termites, but just hands off. So it's really nice. And I'm happy to work with Jerry and Shelly, and they're really great. Every time I call up and just asking, they had actually gave us quotes on some deals that we're looking at. But even just to build friendship, with people in this multifamily business space is really great. So I am a deal sourcer and also a connector. So
Awesome. Thanks, Elise.
happy to meet everybody. Thank you.
Thank you.
Yeah, Elise and Anthony are good friends. They don't live too far from us. They're great people and they're active in the multifamily space. So connect with them. She just dropped her information in the chat. So great people.
Thank you.
Thank you.
Yeah, I have a question.
Yeah,
That deal I sent you earlier, it's a little under the $2 million mark. Based on your other criteria, it might be speculative. Is it possible to glue it in with other properties in the area or across different areas?
you cut out a little bit there. I didn't hear all that.
So is it possible to glue multiple projects together into one portfolio? And what are the requirements about that?
Yeah, when you're looking, yeah, it is. But each property needs to be able to qualify by itself individually. If your loan amount is going to be over $1 million, I'm going to be looking at that one here tonight. But we'll be able to, that would qualify based on the amount, I think, if we're over $1 million on the loan amount. So.
Okay.
Yep. So,
timing wise, what's the typical scenario for time to close, assuming that everything is negotiated in the contract itself?
Yeah, on agency debt, 60 days is what they say. So like from the time that we issue a contract to you, the buyer, and we start the underwriting process, when we issue that, we'll collect the due diligence fee and all those things. At that point, 60 days is the target, but 60 days to 75 days is probably the average.
Okay, that's good to know.
Yeah. Andrea, I see your hand.
Hey, Jerry, Shelly, how are you guys doing?
Awesome. How about you?
How are you?
I'm doing great. I had I feel like I may have forgotten this, but how would I factor in your fee as the broker, the mortgage broker in the deal? Would it be baked into the quote, or would I need to account for that as like a percentage in the underwriting? Hello? Oh, did I cut out?
Jerry, are you there?
Yeah, I'm cutting in and out. I'm going to come into your office, your desk there. I'll be
Okay.
back.
Oh, yeah. Over here.
I thought it was me for a second. It was great meeting you guys in Cincinnati. That was so much fun.
Yeah,
You guys are definitely a dynamic duo when I was out there last time. We just got sent a deal out in Columbus, Ohio, and it's been owned by the same individual under her name. It's like 30 units. And so we're trying to figure out a game plan on how to tackle the financing on that one. It's only like a $2 million purchase price on a 30 unit, but still, I feel like, we're now trying to figure out the underwriting. So in terms of underwriting, assuming we do go with a loan on this property, how would I factor in paying your team in the underwriting? Would it be baked into the quote, or would it be like a percentage?
Oh, like, are you asking about our fee, personal fee on the deal?
Right. Do I need to factor that into the underwriting, or is that just going to be baked into the quote of the loan amount?
When we turn quotes over on anything, that's agency wise, we're going to be 1% of the loan amount. And that'll be in the closing statement and things. So when we turn an LOI over, from the lender, it'll have all those fees and everything in there. And so that's the main fee. That's the only closing fee on there besides, your title and all those things. It's just 1 point. So.
Okay, awesome. And also in your experience with syndicated deals, if you work with syndicators in the past, what have you seen have been like the main reasons that they would go to the finish line on a deal with you guys? Would it be a strong key partner or good reserves for a couple months?
Both of those things have to be there. I mean, you got to have the strong buyer. The strong buyer has done it, but that has done it before. Has everything in place already. So that's why, like Sean, I don't know if you were on here when Sean was on here, Sean Thompson. But when you have somebody like that can step in and he's done it. He's got the net worth, well above what you need, and the experience and everything else, then that makes the whole process way smoother. So, and then you do a few of those deals with somebody like him, and then you're that person, so.
Thank you so much.
Yeah, no problem. And if you have that one in Columbus, if you want us to look at it, just, T12 and rent roll, send it over.
We're working on it.
All right. Yeah, sounds good.
Thanks,
So,
Andrea.
if there's I had bad internet connection in the other room, I guess. So this is way better in this room. But any other questions? If not,
Yeah, I don't know what else is on the, I guess I can pull up my
yeah,
slides.
pull up your slides.
I will share my screen, guys. Ignore everything else you see. There we go. Can everybody see that?
Right here. Needed for a quote. So needed for a quote. T12 rent roll. If you have an OM, that's always helpful. Just because it has all the property information on it. Address and just all those types of things. The summary of what you plan to do with the property. SREO or schedule of real estate owned. And, I'll say that right there. If you have a property that has any type of rehab, if your occupancy is low, your schedule of real estate owned is going to be really important for me to be able to take to a lender right off the bat, because they're going to want to see that you have experience in bringing buildings up to the right occupancy. They're going to want to know that you have experience with the rehab. So as the market has shifted and it's, things are kind of looking dim as far as the real estate market goes presently, that experience and being able to show that experience on deals is more important than ever. So go ahead to the next one. And that's not our next one.
Okay, I did
So-
not change that.
all
Our
right.
next topic is probably going to be,
Development.
oh
Okay.
yeah,
So we'll be talking on our next Zoom, which will be July, what?
26th. Okay, we weren't prepared for this.
We'll be talking
Bear
about
with us.
real estate
26th, yeah.
funding, real estate development deals. So we will be out of town next week, but I still will be available for phone calls or anything anybody needs. We'll be, Ed, you're in Michigan. We're heading up to the Traverse City area up there next week. So we'll be up just north of you there. So
We love it there in Michigan.
yeah, we go
Do
up
it every
there
year.
every year for the last 7 years. We go to northern Michigan for this week in the summer. So
Yeah. So our next call will be July 26th, and it's going to be about development deals. We've got that new product we're gonna share with you guys. And then here is our contact information. If you guys don't have it yet, go ahead and take a screenshot of that. I know somebody was asking in the chat.
Well,
And-
thank you guys very much.
Oh, you
yeah,
are welcome.
thank you for being here.
I'm also with Alex Legends, and I also am with Grant Cardone.
Awesome.
Oh, cool.
So you probably see our son JJ on Alex's call. all the
Yes, I do all the time. He's
Okay.
a great kid.
Oh, thank
Thanks.
you.
Very, very proud of him.
Yeah, so are we.
We are too, yeah. So you guys, Jerry answers his phone all the time. If he doesn't, he will call you back, leave him a message, and he will get all of the information you need.
Yep.
Don't forget our community. JJ, do you want to share that link in the chat if you can? Sunday nights we have Marcel, Trevor, and Victor. They do the celebrity calls. Monday night we have the broker talk. Tuesday night we have napkin underwriting with Ed, Aldo, and Will. And then Wednesday we have us, and then every other Wednesday we have us, and the other Wednesday we have Victor with the advanced underwriting. Yep, I couldn't see there for a second. So if you haven't joined this community yet, go ahead and join. You get all this for free, guys. And like Jerry said earlier, we will be adding a few more classes to this Zoom call with Andrea, who was just on here, and then BB, who was always also on here as well. Great people. Thank you, guys. If you guys don't have any more questions or comments or smart remarks, we will say thank you.
Thank you guys very much. Have a great evening.
You are
Have a
welcome.
good night.
I will leave you guys with some.
Yeah. Thank
Thank
you.
you, guys.
Look
Thank
forward
you
to
so
seeing
much.
Spend a lot of money here.
Thanks, y'all.
Thanks, y'all.
You are welcome.